Hello everybody, this is Toni Turner and welcome to the market now as of about 11:15 a.m. on Friday, May the 20th. Wall Street opened and so far stayed higher today, boosted by technology and financial stocks. Semiconductor stocks were trading higher after Applied Materials, which is an industry bellwether, forecasted a higher than expected third quarter profit on the back of strong demand for chips. Also, a little earlier this week, on Wednesday, the April FOMC minutes release said that U.S. Federal Reserve officials suggested a possibility of an interest rate hike as early as June. Of course, that shook up the markets yesterday. Also yesterday, New York Fed President William Dudley said the U.S. economy is strong enough to warrant a rate hike in June or July. The market's resilient, though, and it moved up today. The S&P 500 index showed 7 new 52-week highs and 1 new low, while the NASDAQ recorded 8 new highs and 12 new lows. Okay, let's go on and look at some charts that could give us an insight into the week to come. We're at a very important point here on our major indexes, especially our S&P 500. As you know, this is a daily chart of the S&P 500 SPDR, symbol SPY. This is the ETF or tracking stock that closely correlates with our S&P 500 index, the benchmark for the U.S. stock markets. So as we look at this daily chart, we see that when I captured it today, it was trading at $205.88. What it's doing here is it's bumping up into its 50-day simple moving average, an important moving average, which is the green line on this chart. Again, right now it's trading at $205.88 and looks like it wants to go higher. The 50-day moving average, if you want to get exact, is coming in here at $205.94. Many times this moving average can act as resistance or a selling point when the price is below it. But the thing is here, a little quirky thing, is that the S&P 500, is that the 50-day moving average is actually rising at this point in time, which makes it not nearly as difficult for price to rise above. At least that's usually the case. We do see the 20-day moving average, the red line, falling down overhead of the SPY. We see that the 200-day moving average is underneath. However, it is moving slightly down. So what we are here for this index, we're at a very, very important point. If we look down here, the RSI is actually tracking the SPY, is making slightly lower highs and lower lows in the very, very short term. The MACD here is the MACD, the black line and the red signal line, is resting right on its zero line. So it's like, can I stay above this zero line, which is very important, or do I fall down? So we're looking at this now for the broader market, and it's very important because if the S&P starts lower, most stocks will follow it lower for sure. If it starts higher, many stocks will follow it higher, so it's important, I believe, at least for my portfolio, to keep an eye on the SPY or the S&P 500. This is an important point in time here. We have to see if, in the face of the fact that it is May, and yes, many times folks go away for the summer, we have to see with the slowing global growth, we have to see with the potential of rising interest rates, if the S&P 500 or the SPY can rise up over above 206. More importantly, can it stay there? We have then, and can it move back up into the 209, 210, or 2100 on the S&P 500? Is it that strong? Or now there's another, I'm going to tell you quickly, we see a head and shoulders pattern here, which is known as a top reversal pattern. The SPY, the neckline of this, which comes in at about 204, was actually broken yesterday by yesterday's price action. But then, to the credit of the SPY and the buyers out there, it actually moved up higher, so it broke it, but today there was no follow-through to the downside. That's a good thing. So now we have to see, this adds more importance to price and price action in the coming week. We have to say, again, can it move higher? Or if not, I put a yellow caution line here. Does it move down below 204 or 2040 on the S&P 500, which is very important because that's the neckline support area. If it moves below that, then of course we have support at 201 and down at the 200-day moving average, which is coming in right now at $201.45. Should the SPY break below that, it will easily head down to the 200 or 2000 on the S&P 500 zone, and maybe from there. That will be an important breakdown if that happens. Again, let's keep our fingers crossed, at least for all our long positions, that the SPY moves higher next week. But I'm waiting to see here if we have follow-through on today's action in the coming week before I add a lot more to my portfolio. Okay, our next chart here is the iShares Russell 2000 ETF, symbol IWM. We've been keeping track of this because the Russell 2000 is the small cap index. These stocks are mostly domestic to the U.S. They are sensitive to interest rates. The IWM, therefore, can be used as a leading indicator for the broader market. We see today the IWM, when I captured this chart, was trading $110.30. It, too, is just below its 20-day, its 200-day, and its 50-day moving average. In this case, the 200-day on the IWM is coming down overhead, which is a negative. That's a pretty powerful moving average. So we'll have to see. If the IWM can move up and break above 111, break back up into the 112 area, then we could see that as strength and an indicator that our broad markets could move higher. If, however, we see it in the coming week rolling over and breaking this $108.40 zone, this is the very important level on this particular ETF or index. Should it break below that, that would not be a positive for the U.S. markets. This is also a shallow head and shoulders pattern, similar to the one on the S&P 500. These are known as top reversal patterns when the neckline is broken. Should that happen then with the IWM and it falls down to 108, if it can't maintain there, then it may fall down to very important support here, down at 104, 105. That's a really important zone, and a move below that could indeed send our indexes lower. So keep an eye on the IWM and the SPY in the coming week to see if there's follow-through to the upside, or if no, it can handle it and it starts lower. Okay, our final chart for today. Now, this is one sector that actually benefits, unlike the small caps, which do not benefit in a higher interest rate environment. The Select Sector SPDR Financial ETF shows us a selection of financial stocks. Top components in this ETF are Berkshire Hathaway B shares, JP Morgan Chase, Wells Fargo, Bank of America, Citigroup, AIG. These financial stocks like higher interest rates because banks make more money in a higher interest rate environment. Financials do, including insurance companies and, of course, regional banks and so forth. So we have here the Select Sector SPDR Financial ETF, the XLF. Now it, unlike the SPY and IWM, is trading above its rising 50-day moving average, which is bullish. The banks are looking forward to higher interest rates. The XLF is also above its 200-day moving average, and it's, when I captured this chart, above its 20 days, so that's a good thing. When I captured this chart, it was trading at 23.32. So if if this move can continue into the coming week, again, on the back of higher interest rates, I might look to, as long as the XLF can stay above 23. Here's my red line down here. I don't want it if it, whoops, excuse me about that. I don't want it if it moves down below into this red line or this red area. I don't want, which is really below the 50-day moving average. If it does that, I'm really not interested anymore. But if it can stay above, say 22.75 or 23, I will be interested in looking at this as a potential long position, expecting it to move up toward the 23.75 zone, maybe up to 24, and head a little higher. That's as long as we see buyers in this particular group here, and the market itself does not roll over in a negative fashion. So I'm keeping an eye on the XLF in the coming week. Okay, now we'll go on to next week's economic reports. But first, please join us this coming Monday online from 4:30 to 6 p.m. Eastern for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. Plus, we have a lot of fun. So please join us. For those who cannot attend our live session, no problem. The recording of our session is available to all of our members a few minutes after the session ends. Okay, for the economic reports, first quarter earnings season is pretty well tapering off. And the economic reports for the coming week: on Tuesday we have new home sales, on Wednesday we have crude inventories, on Thursday we have durable orders and our usual jobless claims report, and on Friday we have the GDP second estimate and the Michigan sentiment report. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.